She's the head of research strategy at Baltic Capital Markets. Kathryn, we came into this year with plenty of momentum for stocks. This morning, it seems like investors doing a little retooling based on their bets on the political situation that's unfolding. What's your take?
Well, we come back to the question of is this not a blue wave, and what does that entail for both the markets and the economy? Because remember, John, we came into this with Chuck Schumer and Nancy Pelosi saying that everything is on the table, including the addition of 2 states, Washington, D.C. and Puerto Rico, the elimination of the filibuster, massive corporate and high net worth individual tax hikes, and the like. So the question is, what is de facto on the table if, in fact, both Georgia seats go for the Dems? That, of course, means a 50-50 split in the Senate, John, and Kamala Harris, the vice president, being the tiebreak. Now, we have Manchin from West Virginia, one senator, who has already stated that he would break with the Democratic Party on the more, let's call it, more left-wing, more radical proposals, such as elimination of the filibuster, which effectively would allow any legislation, John, not just Supreme Court nominees, not just any lower court nominees, any legislation to be passed with a simple majority rather than 2/3, which is what is currently the situation here in the United States. So that's not on the table. That's not on the table, even if both Georgia Senate seats are won by the Democrats. What is on the table, and why the S&P is down 10 points in the futures market, and why I think there's further a slide, is corporate tax hikes. They're going up. In the next budget battle, even with a simple, even with a tiebreak, with Kamala Harris being the tiebreak vote, corporate taxes are going to go up, which means that corporate profits on the S&P are going to go down.
Okay, that's helpful context, Kathryn. If investors are trying to get their heads around how corporate tax changes impact different sectors, how are you thinking about that? I mean, is there a pocket of the market that maybe is more susceptible to downside risk if taxes are going up?
Absolutely. And there are certain sectors, John, that have benefited tremendously from the corporate tax break from President Trump just a couple of years ago. But I would say if we're looking at it from a broad investment strategy perspective, Bank of America did a fantastic analysis that said if, in fact, the Democrats succeed in getting corporate tax hikes up 7 percentage points, which would again put the U.S. in the least competitive position on a global scale with our competitors, then the broad S&P would see a decline of 10% in terms of earnings over the first year. I thought that was a fantastic analysis. But I think the sectors that are most exposed, you named one is tech. I would say banks as well. I would, of course, say the energy market and healthcare as well. So I think these are the sectors that we need to be really attuned to, but in a more broad context. And I think that this is inevitable if we do get both seats lost. Taxes are going up, and one has to ask oneself if the economy is strong enough to withstand this hit to aggregate demand that comes from tax hikes.
It's a good conversation to be having. It feels like in the daily market chatter, we haven't been talking a lot about that. We have largely been talking about the early rollout of vaccines, whether that's successful. I mean, let's face it, there are a lot of people who have been quite hopeful on some kind of return to normal. So let's put those two storylines together. If there is a change in tax policy, does that offset this this momentum that is building in the hardest hit economically sensitive sectors returning to some kind of normal? Because, there's been some big bets recently, maybe on airlines or casino stocks or anybody that was hard hit in 2020.
That's a great point. I think the impact will be delayed, but it is inevitable because once we do get to eradication, of course, being that the vaccine is, as the market has assumed, completely successful, there is no mutations, which I think is a very ambitious assumption, but baked into prices. If we get to the eradication phase, then the market will move back to fundamentals. At that point in late summer, when we do have corporate tax hikes, when you do have the highest earners in the United States being exposed to additional tax hikes and the negative impact on revenue and job creation that ensues, then I think you could see a delayed reaction in the markets. It doesn't surprise me that the Dow is up today in the futures market. It wouldn't even surprise me, John, if S&Ps turned positive because the market is kind of addicted to stimulus, and they think, wow, Democrats, big spenders, we already have $5 trillion in fiscal stimulus. We're going to get another $5 trillion. So the markets could be ecstatic about the big spenders, but I think that it's going to hit hard home when we do see the impact of those tax hikes.
I'm glad you brought all that up, though, Kathryn, because what's been so strange, really, about what we've been living through this last year, the stock market realities versus the realities outside our door. You go back to March and the big rally off those lows, and I think a lot of people look at that. I mean, sure, yeah, there's a reason to be cautious on a whole bunch of fronts, but you snap your fingers and you missed some of those outsized returns. In fact, you've put together a chart that shows some of the different sectors and the outperformance we have seen since the March lows. We'll show that to our audience as well. And it just is a reminder that there haven't really been a lot of moments for pause, if you will. I mean, if you're just to set it and forget it and you're just going to worry about how your stocks do over the next 10 years, that's one thing. But I think investors who have been waiting, for example, that great buying opportunity, the pullback, saw this kind of performance off the March lows and sort of have felt the need to stay pretty close to the daily trading activity to see where things are going.
Yeah, and that's right. And they shouldn't expect a massive correction unless we do get some form of anomaly with the virus. Let's say a mutated form that the vaccine isn't effective on, or even the Georgia elections. I don't think it's going to cause a massive correction because we have two fundamental drivers, John, which are not going anywhere while inflation is low, and that is enormous fiscal stimuli and more in the pipeline, and monetary stimulus, which has been tremendously effective in boosting Wall Street while Main Street continues to suffer.
All right. Helpful context, 10,000-foot view there. Let's talk a little bit more about some of the areas of the market that you are keeping a close eye on, maybe areas that you might be doing some buying in, let's say, over the next 6 months.
Okay. Yeah, look, I think there's certain areas, the famous rotation trade, which we saw starting to gain speed in the back end of last year in 2020, which is the infamous rotation from a market wholly driven by technology stocks to one driven by more value named stocks. So I like sectors such as banks. I think even if you have kind of a hung Congress where the Democrats do take control of everything, but cannot do the more, egregiously anti-market policies that have previously been proposed, then we still get sort of a status quo. And in that situation, with both fiscal and monetary stimuli, you're going to see a massive rotation into those less appreciated sectors, such as banks, such as even staples, sectors that have really pulled up the rear. My favorite pick, though, is emerging markets. I think that with the U.S. dollar collapsed, and with interest rates extremely low, and with guys really needing to look for return, emerging markets are going to be the biggest beneficiary. And that is the asset class that has really pulled up the rear.
Yeah, it's a great point. And look, the virus on some levels is something you can't ignore on that front. Like there are a number of emerging markets, Asian nations that have a little bit more experience with dealing with these kinds of situations and arguably have done a better job in navigating through it. That's important for the economy story. We've been talking recently about the rally in Chinese stocks, which, sometimes gets distracted in all the other daily headlines we're going through. And before I let you go, Kathryn, you mentioned big tech and the possible worries there based on how things are playing out on the political spectrum. That has been the easy sector to bet on. It is seeing some weakness this morning. Names like Facebook and Google and Amazon all seeing a little bit of pre-market weakness. But I go back to that initial point. Anyone who was waiting for a big pullback in these stocks typically came up short. How do you think tech is going to be viewed by investors over the rest of 2021?
I think it's still going to be generally a favored sector because my suspicion, John, is that vaccine doesn't equate to eradication, especially immediately. We're still all working from home here in the United States. A lot of children are not in school still in many states. Where I'm from in New Jersey, New York, New Jersey, Pennsylvania, Connecticut, it's all shut down. So I think that this is going to take longer than the market is anticipating, which really I think will support stay-at-home stocks and technology. And the fact is that even though technology it has appreciated quite a bit in value, it's still more than a quarter of the market cap of the S&P 500. And if, in fact, we continue to get this Federal Reserve stimulus, which continues to support the search for risk, with equity risk premiums being so far above fixed income, it's inherently supportive of the broader markets, of which tech is a massive component.
All helpful context. Kathryn, thanks so much for breaking it down for us on this Wednesday morning. Kathryn Rooney Vera joining us from Baltic Capital Markets.